GM, good morning. Welcome to the Milk Road Show, the daily crypto show that's as refreshing as stepping off the plane into a new city. I'm your host, Jay Hamilton, and today we are joined by Lark Davis. In today's episode, we will uncover how significantly the Fed rate cut can impact the markets and specifically the crypto market. On Wednesday this week, there's a rate cut coming. A lot of questions. Is that rate cut already priced in? If not, what should we expect to happen? If there's no reaction, is that a bad sign? And most importantly, what should you be watching out for when you hear the news come out on Wednesday so you're not fooled by the mass amount of media that comes out all at once? Before we jump into today's episode, one quick announcement. Starting this week, we are now releasing our show at 3 p.m. Eastern every day. Hope that doesn't make too much of a change in your schedule, but make sure you tune in every day at 3 p.m. And as always, want to give a shout out to our friends over at Kelp DAO. Get ready because your reward farming game is about to level up. Introducing Gain, powered by Kelp, your DGen concierge. Gain is an automated vault launched by Kelp that maximizes rewards for ETH users. It offers one-click access to airdrops and points from leading L2s like Linea, Scroll, Karak, and more. Here's how it works. Head over to milkroad.com/Kelp Gain and spot airdrop Gain. Get a complete overview of how your assets are deployed and the rewards and points you stand to gain. With just a few clicks, deposit ETH or SETH or liquid staking tokens into the smart vault. That's it. The best part, once you deposit, you're issued a liquid token, AgETH, enabling you to participate in DeFi on Pendle, Spectra, Lyra, Splice, and others. Gain is already live and you can go check it out for yourself today. Just head over to milkroad.com/Kelp Gain and get started. Lark, welcome back to the show. It's our favorite season. It's rate cut season. Everybody loves it when the rates are coming down. Lark, on Wednesday this week, the Fed is going to announce a rate cut. I'm putting money in their mouth or words in their mouth. I sure hope they announce a rate cut. It seems very likely. I wanted to do a show today to talk about what we can expect as a result of those rate cuts from a market standpoint. What do you expect to see on Wednesday? And historically, what would you expect to see how the markets react?
Rate cuts are here, man. It's very, very exciting. Obviously, everybody wants to know what Jerome Powell is going to do with the money. I feel like in the future, we're going to sit down and sit around the campfire in the post-apocalyptic Armageddon and tell our kids, back in the day, we used to sit around and wait for one man to tell us what was going to happen with the money. Look, obviously very impactful for us nerds. What's going to happen with the Federal Reserve? What has become of our lives, Jay? Anyway, no, seriously, very impactful for anybody in markets. Look, if there's no rate cut, that's, I think, one of the least likely scenarios right now. And Jerome Powell's really going to surprise the markets if there's no rate cut coming through. That's going to shock everybody because basically everybody thinks that Jerome's late, that he should have cut back in July. He didn't. Now everyone's saying, Jerome, you're late. We had the yen carry trade crisis that unfolded, and maybe they wanted that to happen. They're never going to tell you this, but maybe they wanted that to happen. They wanted to see some crisis and some real strain to say, now we have justification to really start cutting. So that becomes a question. Most likely scenario is the Fed's going to cut. The question is, how much are they going to cut? Now, we had Elizabeth frickin' Warren out here penning a letter to the Federal Reserve saying, you got to cut 75 basis points. There's too much damage has been done. This has got to be big. You got to go big or go home, Jerome. And that's kind of where I think the market would look at it's a panic move. It's too much. And you're not going to, of course, rely on what Elizabeth Warren is saying or not saying about the rate cuts. But if you had a 75 basis point cut, the market would probably go, holy crap, something's really broken here. And the Fed's panicking. Right? So too much is actually not going to be good. Now, the other side of the equation is it going to be 25 or 50 basis points. Right now, the prediction markets are favoring a 50 basis point cut because of the weakening in the labor markets that we've seen. Now, is that what's going to come to pass? I don't know. Nobody knows. Jerome knows, but nobody else knows, right? So a 25 basis point cut may not be enough. The markets may not love that. To an extent, most of this is already priced into the markets, by the way, and you probably are going to expect a bit of volatility, a bit of a buy the rumor, sell the news even in stocks and in crypto. We shall see. Maybe we bounce harder than people expect, but usually these big news events get people super, super excited and then are a bit of a letdown on the reality of like, oh my gosh, it's only a 25 basis point cut that doesn't really help anybody do anything. A 50 basis point cut does provide a little bit of relief and starts moving us in the right direction. And maybe then companies can say, hey, 25 or 50 basis points, companies will be able to look and say, hey, at least we're moving in the right direction. The rate cuts have started. We can start doing things because we know we'll be able to refinance our debt because things are going down. So we're going to start taking a bit more of those risks, hiring some more people, whatever it might be. And then we can refinance that debt when the rates go down more later because now it's happening, now it's starting, et cetera, et cetera. So this starts to become a spark that kicks off economic activity. 25 basis points doesn't really help anybody out the gate, but at least sets us in motion in the right direction. 50 basis points, that actually can start really moving things along a little bit. Although a month ago, if you talk to people, they would say 50 basis points is going to be a bearish cut. Now it almost seems like it's consensus that we need 50 basis points to be a bullish cut. And remember, folks, when we have a rate cut in a non-recessionary environment, it tends to be bullish. And I don't know if you've been looking around recently, but there has been no recession declared for US markets. So generally should be a bullish event for the longer term over the next months, over the next days. Watch out for volatility in the markets.
Yeah, you mentioned that a 25 basis point rate cut doesn't really do much for anybody. But if we step back, who is affected by this rate cut, regardless of if it's 25% or 50, sorry, whether it's 25 or 50 basis points? Who does it affect most immediately, and how will it change the flow of money globally, not just in crypto?
Yeah. So when you really start seeing a lot of rate cuts coming, we get back down to like 3% or something, then people are going to be able to start buying houses and stuff again. But the current rates is just too high. So the housing market's not going to get a lot of relief from a 25 or a 50 basis point cut. You're going to need more like 150 basis points of cuts to really start seeing, okay, people are going to start taking mortgage again, people are going to start buying properties, et cetera, et cetera. But you got to keep in mind with US debt, it's got far-reaching global implications because the US is the reserve currency of the world. There's a reason why we talk about the Federal Reserve and the US dollar and US treasuries and stuff like this, because it's so globally impactful, because it is the reserve currency of the world. So governments around the world who own US debt will be looking at this move. We see all these different people around the world doing carry trades where they can buy local currency at much lower interest rates and buy US debt and get higher rates of return. All these kind of things start to come into play, right? And so as we start to see interest rates get cut, we start to see unwinding in those different plays. We could see people selling off treasuries, et cetera, et cetera, et cetera. So there's a lot of impacts on how this can actually hit the markets, a lot of different ways that may not always be immediately apparent. Foreign governments holding that debt, but also then spurring of new economic activity and how that can have a positive impact on the US economy and balance out any sort of deleveraging events that we may see. So there's a lot of interesting ways in which these tiny mechanisms can have giant global impacts.
And when we think about this rate cut, when we look back at historical rate cuts, they tend to happen in fast sequence because, as we know, over the past, well, since 2008, when we've been in this period of real monetary policy, monetary control by the large governments, they have been looking to direct markets quickly. And so when we look at the rest of this year, what do you expect to happen? Will we continue to get rate cuts? I think we have 2 or 3 more meetings this year. And what position could that put us in sort of throughout Q4?
So I think the market right now is looking at around 100 basis points of cuts between here and the end of the year. So whether we get a little bit less or a little bit more, of course, remains to be seen. But that's sort of around the base case, is around 100 basis point cuts. So basically interest rates in the USA are going to fall by 1%. So they're around the 5.25 to 5.5% mark right now. They're going to fall down to the 4.25 to 4.5% right now. So that has a lot of impacts on the market, because the market starts getting very bullish around this narrative that, okay, the Fed's going to nail the soft landing, all this kind of stuff. Will the Fed fully nail the soft landing? Well, it remains to be seen. Will they avoid a recession, right? Very interesting. Now, there's still a lot of risks. We could have no recession, but just a stagnant economy. Inflation could make a comeback, which is, of course, what everybody's worried about right now with these rate cuts, is that if the Fed cuts too much too quickly, it spurs too much economic activity, and then inflation starts coming back, and that's a problem too. So the Fed's really got a very small window to pull this off in terms of lowering rates, keeping inflation down, and making sure nothing blows up in the process. And I don't know if they're going to be able to avoid nothing blowing up, but as long as nothing really big blows up, then we're going to be okay.
Something's
right?
going to blow up, but let's just hope it's something small.
Even if we get 100 basis points by the end of the year, that can be really, really big for businesses. And so think about businesses that might have been holding off hiring any new people, for example, or buying that new machine, or building that new office building, or whatever it might be. They can now start looking at doing those sorts of things, which starts the trickle effect of creating new economic activity. You have new people who have new jobs because these companies can borrow money again to hire people and to build things when they're building things that requires more people and more jobs. So the more these interest rates go down, the more companies feel confident that they can start using the money system again to expand their businesses and to grow the economic pie, essentially.
Does having the ETFs make flow as a result of rate cuts more likely to happen faster? We have larger pipelines now that can come into crypto. So if we were to hit these 100 basis points cut by the end of the year, how would we see that flow come into crypto, and how quickly?
It can come in very, very quickly now, especially at the top. And I know Ethereum ETFs have been not so great so far, but that won't last forever. As soon as we get more risk on attitude happening, then we're going to see these crypto ETF products really show their strengths. And we're already starting to see more risk attitudes. We're seeing the low cap stocks in the USA starting to get a lot more attention, a lot more bid, more rotation from those sort of mega cap tech stocks down into the lower stuff as people seek bigger gains in the market, realizing this big tech's, at least in the short term, pretty overextended. So when it comes to crypto specifically, people will start taking risks. You got to keep in mind there's $7 trillion or something like this sitting in money market accounts. And look, a lot of that's just low risk money looking for low risk yield. But there's a percentage of that is going to look at the rate cuts that are happening and the falling yields in those money market funds and go, well, it's time that I take some more risk. It's time that I put my money somewhere where it's going to get more than it's going to make sitting in this money market account. So we'll see a bit of that. There's a huge amount of stable coins, specifically to crypto, a huge amount of stable coins sitting on the sidelines right now that are just ready for that break of probably 72K for Bitcoin to say, yes, risk on season is definitely back. We're going to start gunning for new highs, all that kind of stuff. And that can happen very, very quickly. It's crazy to look at the Bitcoin ETF because it's been such a wild runaway success. And I know we've had some out days in the past few weeks, but then late last week, we had a $250 million day again for inflows, right? We've had $17.5 billion total inflows for the year. This, by any metric, is a wild success for an ETF launch. And that money's going to just keep coming in. And as more money goes into the top, here's how it works. Bitcoin's the tip of the spear. It always has been. And when we start seeing liquidity flowing in from Wall Street into Bitcoin and into Ethereum as well, that money starts trickling down. Now, it doesn't trickle down from the Wall Street money per se, but because the prices are going up because of those Wall Street inflows, on-chain whales for Bitcoin and Ethereum, they start taking profits. They start rotating profits into altcoins because they understand how the market flow works.
Play two scenarios out for us. 25% basis cut happens this week. 50% basis cut happens this week. What do you think could happen as a result of each of those immediate impact in the markets?
I think no matter what happens this week, expect volatility. So if you're using leverage, just be careful this week, guys. I know there's going to be people who will directionally be right on longing or shorting, and they'll do that very successfully. A lot of people will probably be caught on the wrong end of that. And there could be volatility flushes where we see a big drop followed by a big rally, and that could happen within a few hours, and a lot of people get washed out. We see this happen around these kind of big news events, so just be careful. If you are going to be using leverage, keep it low, guys. Okay. Warning from Uncle Lark there. In terms of 25 basis point cut, I think the market at this point is going to welcome it, obviously, but may almost think it's not enough considering how the jobs data and stuff has been. So maybe it's not going to be as bullish as we'd like it to be. Again, rate cuts in a non-recessionary environment have historically been bullish. I don't see any reason why that wouldn't be the case this time, although we may have short-term volatility. A 50 basis point cut at this point as long as the Fed's tone, I know we all have to sit around and dissect, is how's Jerome talking? What are the words that he's using? Is he being overly hawkish or is he being too dovish? The markets would literally sit around. I get nerds. I know we're all nerds. Just deal with it.
And we'll be here talking about it all week.
We'll be here talking about it, guys. Anyway, but a 50 basis point cut with sort of language around like, look, we see what's going on in the jobs market. We want to support jobs markets and et cetera, et cetera. And then, of course, you still have to watch jobs market data over the next few months. But a 50 basis point cut could show confidence for the market that the Fed is willing to do what it takes to get the jobs markets back in order. So I think the market's probably going to like a 50 basis point cut at this point. Again, a 75 basis point cut, if that were to come to fruition, would probably not be a good thing. It's probably going to be seen by the market as the Fed's lost control. It's too much, etc.
When Jerome does his speech this week, not to become overly analytical, but and nerdy, is there anything you are watching out for or aren't watching out for? And for those viewers who are going to see a whole bunch of news across the crypto timeline, what are the red flags, or what would be your advice in terms of how to digest that news?
Sure. I think at this point, it's really all about the jobs data, and inflation has come down massively. I think we saw the last fall down from 2.8 or 2.9 down to 2.5%. So another huge fall in inflation, almost back in line with the Fed's 2% inflation target. So inflation's currently not a story. It could rear its ugly head again if the Fed cuts too hard, too fast, spurring a new inflationary wave, which would be bad when it happens. But there's a big window between when the rate cuts start and inflation peaks up again for markets to rally higher. So there's that to keep in mind, okay? Now, in terms of the things that he's saying, it's all about the jobs, guys. It's jobs, jobs, jobs. And that is what Fed chief said last time. And I expect him to say very much similar this time. Now, where are we at with jobs? What has the recent data been saying? Well, we saw the unemployment numbers fall from 4.3 down to 4.2%. That was announced about 10 days ago now. So that's a positive. That's a positive thing. Now, we are still trending a bit too high for the market's liking. There's still a fear that it's going to trend back up a lot higher. But it's all worth keeping in mind that we've just come off of basically record low unemployment. And that 4.2% or even 4.3% is historically very, very low. Generally, healthy quote unquote unemployment numbers range between 4 and 6%. So we can go all the way up to 6% and still be within a healthy range. The fear, of course, is how fast it steepens. If we slowly grind higher for a few months and get up to 5.5% or something like that, it's still within the realm of normalcy, but the markets may not like it. So you have to keep this in mind. But generally, the market has been a bit overreactionary towards unemployment data. Everyone's kind of got this PTSD from previous market meltdowns that, oh my gosh, it's going to start steepening really, really fast. We're going to go from 4.2% to 6% next month and 10% by the end of the year. And you have these sort of catastrophic predictions on how things could play out, which probably won't come to pass. But still, that's what the market is fearing. Right? And market is very much driven by this fear that we are going to have this recession coming sooner. And it's all going to be about the jobs market. So we're going to be listening to what Jerome has to say about the jobs markets. The data has been revised down for total numbers of jobs created, but we're still around 100K or 100K over per month for US job creation. So it's not bad. But again, they revised the data down, which the market didn't like when that happened earlier this month. So we just have to keep listening for Jerome and what he's saying about how he sees the jobs market. There is softening in the jobs markets. And I think that's going to be used as the main justification for rate cuts this week.
So if you're a nerd like us, 2 p.m. Wednesday, tune in for the FOMC meeting press conference. No,
we're going to get our popcorn out.
You probably won't tune in, but we will. And that's why you keep listening to the show, because we'll keep you guys informed. Lark, thanks so much for breaking everything down for us today. I just want to mention, I know you're at Token 2049 and Breakpoint this week in Singapore, as are a couple members of the Milk Road team. So anybody listening, if you guys are there, watch out for Lark and for the Milk Road guys. They'll be wearing Milk Road t-shirts. The Milkman won't be there, unfortunately. But look out for our team there as well, because we always love to meet our fans in person. Thanks so much for listening in, everybody. Have yourself a wicked awesome day. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.